Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. Thanks for coming here each and every week. And you know what? When you come, you hear or you see the show, you want to go to the Big 8 podcast, one of the many that we're on. Daryl, you have that list for us?
I sure do. It's Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, and YouTube.
Excellent. Yeah, if you go to YouTube, another place you can see and hear the show, Jeff Barton, the Mortgage Voice. That's our channel. Click on that, and you'll be able to hear, see, and if you like it, say you like it. Join up. Reason is more people that see us, hear us, we spread the word, we get the message out, and the message is really what's going on in the mortgage industry, what's happening in the real estate world. We're on a number of radio stations. Our reach is pretty wide. We go from Albuquerque, New Mexico, all the way up to Las Vegas, Central California, near Lake Tahoe, and of course, in the Inland Empire, our flagship down there, KCAA and KMET, they've been with us, and we've been with them actually for a number of years. We reach a lot of people in the Inland Empire in Southern California, and we're really happy that we do that, happy that you listen in. Again, if you hear, see, sign up, say you like us. Again, it helps us get to people that, quite frankly, won't hear this anywhere else. Most of these shows are about commercials for the person who's sponsoring the show. Malibu Funding, who sponsors this show and who I work for, they're nice enough to let me do what I want, which is really try to inform you, the consumer, people out there who just don't know anything. I've heard comments from people, and then again, for me, it's, kind of every day. This is what I do all day for years, decades really. But for a lot of people who don't do this every day, who only do it when they either want to refinance their house or they want to buy a house, it's information that they don't know. And so the sources that we use and the experience that I have in the industry allows me to be able to just very easily talk to the number of guests that come on the show, as well as talk about what's happening in the mortgage business. A lot has happened since COVID began. One of the main issues of COVID was to provide relief for those people who lost their job through no fault of their own, or who can't pay their rent through no fault of their own or pay their mortgage. So what happens to these people? What happens when, like I say, they lost the job, and it looks as if, that's going to go on for a while because, as we all know, this COVID-19 pandemic is lasting forever. And you know what? I'm not going to be the first one to say it, but a year from now, we might be in exactly the same place, because every time you hear some positive news about vaccines and immunization and herd immunity, what happens is somebody else says, well, that study's not great, or, that trial's got to be postponed or delayed, or whatever it is that is slowing down the optimism that really wants to boil to the surface so that people can go out to dinner and have fun at the movies. Most importantly, for those people who have not worked, they can go to work, get a job, be able to pay for their rent, their mortgage. Forbearances, which is the term they use for not paying your mortgage, which has been passed by Congress as a short-term solution, may turn into a longer-term solution. And that 3.6 million people who are in forbearance as a result of losing their job through no fault of their own, well, this group has become now a problem for the banking industry. There's a term, and we've gone through it on the show before. It's called, what is it? I have it here. It's called late stage delinquencies. That's what it's called. That's a fancy way of saying someone hasn't really paid their bills for a while. Well, because since March 15th, when the president said, hey, we got to sit out for 2 weeks and see where we are. Well, if you went into forbearance in March, March 15th, let's say, and you haven't paid your mortgage since then, you would be considered late stage delinquency. Now, they don't make an exception or delineation between you and the person who isn't in forbearance. You're just late stage delinquency. And late stage delinquencies are, 7% of the mortgage market. That's a lot, right? From what I understand. So if you're looking at how the mortgage market functions, normally we're functioning at about 2 to 3% late stage delinquencies. Now, we haven't gone into foreclosures, and oddly enough, last month, in the month of September, well, let's go back to August, month of August, we've had the lowest number of foreclosures ever on record. Now, those two numbers don't match, right? If you've got late stage delinquencies and you've got the lowest foreclosure rate ever, obviously the only way that the late stage delinquency doesn't turn into the mortgage foreclosure is because the government said, hold on, I'm going to give these people a timeout. And if my reading of this is correct, when the new Congress gets in, the new president or the old president, whoever it is elected or reelected, we're going to have to address this problem because forbearance ends January 1, 2021. Now, I know nobody is going to have their job back. I mean, those people that have already gotten their job back and have been working are now hit with another round of layoffs, whether it's at the theme parks, Disney laid off 28,000, whether it's at the airlines, another 30,000 laid off there, or any of these large corporations that are dependent either on travel or entertainment in large groups in large areas. All of those people are getting laid off. And the reason that is because the government PPP program has ended for most of these businesses. So if the government's not going to pay their salary, we can't afford it. So all these people getting laid off, which is why the unemployment numbers have suffered. And they've suffered this month, September, or last month, September, more so than they had through the summer months when we were seeing a lot of people get back to work. Now, conversely, here's another oddity. Even though we've seen more people be laid off, actual unemployment percentage-wise number went down. Let me quote that here for you. The unemployment rate is at 7.9% in September. Well, that's really down from the height of the unemployment rate. But there were 26 million people claiming unemployment insurance last month. Now, we know at the height we had about 22 million people out of work. We're supposed to have about half that out of work now. But with unemployment rates falling, but numbers seem to be rising. Again, the way these things are calculated, like all numbers with government associated with it, makes no sense. We've got issues with all of this and how we're to address going forward through the pandemic. Now, what does this mean for you? Today, what does it mean? It means you can get a 30-year fixed rate loan at 3%, a 15-year fixed rate loan at 2.44%, an FHA loan at 2.4%, a jumbo loan at 3.3%, and I'll bring up the ARMs, right? You can get an ARM today at 2.78%, 5/1 ARM. Now, these averages across the country depends on you as the borrower, what you make, how you make it, and what your credit score is. If you're golden A paper, which is 750 to 850 FICO score, 20% down on a purchase, or if you've got a job you've been in for a good number of years and you can prove W-2 income, you're what we call a golden borrower, right? So you should be able to get very close to these rates. Now, in my looking at this, looking at these rates versus what we see as a problem both in unemployment and the forbearance, there is a split in what we're doing here. There is people that can and people that cannot. Now, if that doesn't sound familiar to you, it should, because we've been having this split in a lot of areas in the country, economically, financially, and how people live and what they can afford and what they can't afford for decades. And it's been happening and exacerbating under this particular administration through no fault of their own, because of COVID. And we see it no more plainly than the health care has been received by the president and the first family versus what's happening with you out there in the street who's got Uncle Billy Bob in the ICU. Anyway, the answers are not forthcoming, but this is the problem. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
Right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to the Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening. Thanks very much for tuning in each and every week. We are on the Big 8 podcast. We're on YouTube, Jeff Barton, the Mortgage Voice. I do a 2 or 3 minute update on a daily basis, and we're all over a bunch of different social media outlets, and whether it's Instagram, Twitter, or Facebook, or LinkedIn, or any of these, you can see it or see that on our YouTube page, Jeff Barton, the Mortgage Voice. We're on 5 different radio stations in 3 different states, from Albuquerque to Las Vegas, Nevada, in the Inland Empire, as well as up in Lake Tahoe area. Really appreciate those audiences that driving around on a Saturday trying to figure out what to do in terms of your housing needs and want to buy a house. Tune in, you can hear us, and we'll give you some solutions as to what's happening in the mortgage market. With us today, once again, Tomas Trujillo from Lone Stream. Really appreciate him coming on, give us his idea and perspective as to some of the new products and some of the difficulties people may be having getting a mortgage today. Tomas, how are you?
I'm great, Jeff. How are you today?
I'm fine, thank you. Thank you for coming on. I know you're pressed for time. Let's get right to it. Tell us what's happening at Lone Stream. Give us an example of 2 or 3 products.
Well, right now what we've done is after COVID, after the big COVID shutdown, we started to bring back some products. We have our DSCR back, which is where the property will qualify for the income, not the borrower. So I don't need to see any taxes. I don't need to see any pay stubs, nothing. I'm just making sure that the property will take care of itself. That we have our I-10 loan back, which is pretty good.
Okay, go ahead.
And our I-10 loan, so we can go up to a max of 85 LTV. So if you're in the country and you have an I-10, we have a loan for you. We can go up to 85, 5% of your own money. The rest can be gift. Rates aren't too bad on it. It's pretty fair. We'll even do a DSCR on that. We can do a bank scheme on that. So it's not going to be a traditional Fannie Mae loan where you have to give me bank statements, W-2s. We have borrowers who own gas stations, who own tire shops, who just qualify off their bank statements. So we're kind of excited about that.
Yeah, I would say so. I love that program, by the way. Now, I had a quick question for you. There's a couple of ballot initiatives, and for those people who are in different states than in Southern California who are listening to the program, I'm sure in your areas too, you have ballot initiatives as well as local ordinances and statewide laws being passed to protect renters. Now, some of these DSCR programs, are they pro forma rents or are they actual rents? Because if we are reading the tea leaves correctly, if some of these ballot initiatives get passed, it will freeze or have rent control back in place, and how would that affect the loan?
Well, since you're not giving us income, so we can't really verify it. So if you tell me that you have a property that you're buying and you have renters coming in, because some of the renters are going to leave, then I'm going to take you pretty much at your face value. I'm going to ask you for a rental agreement or a lease agreement showing that. And I'll verify that. I'll maybe go to Rental Meter, or I'll pull Zillow to find out what the rents are in the area. So if current rents in the area are about $2,500, you're telling me you're going to charge $3,500. We'll look at that kind of like, I don't know about that. But if you okay, I get that. If you're elder and you're on Social Security, I'm not asking you for any of that. I just want to make sure that the property is going to qualify. So we don't do a whole lot of looking on those programs.
Tell me something about your credit score, your FICO requirements for some of these loans. Are they credit driven, or are they mostly, as you say, driven by either the rental that you're going to get or by your bank statements if it's an I-10 loan?
Well, on DSCR, we have two DSCR programs. We have the DSCR Select, where you have to be at least a 680 FICO, and it has to be the credit has to be pretty decent.
Okay.
We have another program, which is our regular DSCR, and on that one, you can have a BK, a 3-year BK. You can have at least one times 60 on it, which would mean you can have 230s and a 160, and you're okay. So we're a little more flexible on that one. On that one, you can cash out. You can obviously it's a non-owner. You can't do that owner occupied. So there's some flexibility in that program.
Okay.
We don't. Before it was you had to be at a 1.17 to qualify. Now, if your rent will cover at least 3/4 of your PITI, you're good to go. So we've dropped that as well.
Okay, so you seem to be more bullish. What I'm reading is that there is some tightening of credit for housing because the unemployment rate went up. Well, not the rate, but the unemployment numbers, not great. We didn't see as many people getting hired back as we had in the previous summer months. And so there's a tightening of credit in the mortgage market. Do you feel that over at Lone Stream, or is it just business as usual?
Oh, absolutely, absolutely. We have our COVID guidelines that we follow prior to funding, but with this program, it doesn't really play because we're not looking at your income. So that's one of the great things about this program in particular is if you're doing a regular loan, if you're doing anything else, if you're doing a bank statement loan, we want to call. We want to make sure that the borrower is still working the day of funding. We want to make sure we want to see some kind of income saying, hey, he's still getting paid. He's not furloughed or he's not this or that. The credit has tightened a little bit. We are looking at is the borrower on a forbearance with the bank.
Right.
So
right.
Yes, there is that.
Right, and that's one of the things about the long-term delinquency is that we've still got a real solid chunk of people that haven't paid a mortgage since March, maybe 3.5 million people. How's that affecting credit decisions with you all? Like I say, depending on where the election goes or where, I don't know, COVID goes, we could see a lot more people out of work. And we're still trying to wrestle with lack of housing in Southern California. It's a conundrum here that I don't know how we can solve.
Yeah, absolutely. Yeah, that's a question for the higher ups. That's not something.
No, it's your problem. No. I'm not going to let you off the hook. You're the guy that's you're boots on the ground. You see it every day, and as we all know, because of your proximity to local agents, real estate agents, and such, are you seeing that there is, I guess, more demand on housing, i.e., there's more demand for you to come up with pre-approval letters, more or less turn times in order to have a buyer or somebody get a property that they're competing for? Do you see that more as well?
Oh, absolutely. Right now, the rates as low as the rates are, we haven't seen rates this low. I don't know if we've ever seen them this low.
Right, never.
That being, people can afford more housing. So now, I mean, it's going crazy out there. Everybody's turn times are horrendous right now. They're not what we want to be. I mean, I've heard some lenders are up to a month just to underwrite.
Yep.
But we're not that bad yet, but it's absolutely a huge demand right now.
Well, I have a condo myself that I'm selling. It's not mine, it's a customer of mine's. And the buyer is doing a loan with Citibank. And they asked for 40 days. And easily, right. Especially a big bank like that. I don't know how many they're turning every month. But like say United Wholesale or Rocket Mortgage, and both of those companies, as I was saying, have just gone or are about to go public. It's difficult with larger companies doing, $50-100 billion a month to be able to not only compete, but to get their turn times down. I mean, it's kind of a toss-up as to which I would like, lower rates or faster turn times, especially if you're a seller. I don't care about your rate. I only care about getting my money quicker.
Absolutely. Absolutely. Well, that's why I think it's important that the loan officer does his due diligence, has everything ready to go, because the longer the loan officer waits to get everything in, the longer it takes. It can drag out to 6 days at some point.
Oh, yeah.
But
Oh, yeah.
you have that guy, when you have, actually, I did a loan for one of your guys. He closed it in under 30 days because he was ready. He had all his stuff ready. He submitted it once. He went to the underwriter, got signed off, got CC'd, got docked, funded.
Wow. Hey, good job, my guy. Perfect. Tomas, thanks very much for coming on again. I know you're busy. You got an appointment, and really appreciate once again filling in and telling people. Could you shout out your phone number, let people know how to get in touch with you?
Sure. 323-228-5181. My name's Tomas.
Thank you very much. That's Tomas Trujillo for Loan Stream. I'm Jeff Barton for The Mortgage Voice. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. We're on the Big 8 podcast. Daryl, you got those Big 8 right there?
I sure do. It's Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, and YouTube.
Okay, if you go to any of these, click the You Like the Show and join up. We have archived every one of these shows. If you go to YouTube, Jeff Barton, The Mortgage Voice, that's my mortgage channel. And of course, we're on 5 radio stations, 3 different states. We have probably 50,000 people a week who listen to the show on the radio. And certainly all of the social media outlets, we are on a daily of about 3 to 5 minutes that we do. So you can find us. Information is good, but it's not as good as the next guy I've got coming up. I'm excited to bring back Reed Blake from Intelligent Capital Solutions. Reed, how are you?
I'm doing really well. Thank you very much, Jeff. Good to hear from you.
And thank you very much for coming on. I'm always excited to have you on because it's a different end of the business. And I think a lot of people, especially in this market, are looking for alternative solutions to funding their business. Could you give us an example of what you do, how you do it, and what's happening in the market currently?
Sure. Happy to do that. Excuse me. Happy to do it. What we focus on are primarily 4 categories, but we do all types of funding. The first category are unsecured business lines of credit, and those are general purpose lines of credit that can be used for any legitimate legal purpose that a client wants.
Okay.
Doesn't matter what the industry is. The second thing that we do are unsecured general purpose cash loans. These range anywhere from $60,000 to $350,000. And again, they're just unsecured cash loans. The monies are wired into the bank account within 3 or 4 or 5 days, and the business owner can use them however they choose. The third category that we have, and this has been new and really, really popular, and that's been what we call our professional certification program. These funds range from $10,000 up to $500,000, and they do not report to the business owner's personal credit, not in any way, shape, or form, similar to the unsecured lines of credit. Only, just again, not to the personal credit, to the personal credit report. And these are for people who have professional designations. So it could be the doctor, an MD, or it could be the nurse that has an RN. Either one of them will qualify for these funds. It can be a CPA, it could be an enrolled agent, it can be a certified contractor, people in the trades, it could be someone who's a journeyman or a master, et cetera, et cetera, et cetera. So if they have a professional designation in their category, then they'll qualify for this program. And again, it's $10,000 to $500,000 that is unsecured and not reported to the personal credit report. The fourth one that's also super popular lately in the real estate community is one of our new real estate lines of credit. It's spectacular. Folks qualify for a minimum of $500,000 up to a maximum initially of $10 million. This is a line of credit that can be used for anything. It can be used for rehabbing. It can be used for buy and hold. It can be a new build, new construction. It could be Airbnb. It can be used, again, for anything. And what's really cool about it is it's not that difficult to qualify for. For example, The mid score on this to qualify, there's 4 qualification criteria. The mid score is 640. As long as the mid score of the 3 is 640 or higher, then they can proceed into the process of being approved. So it's powerful. And again, it's money they've got. They don't need to run around with a hat in their hand wondering where to get funding, et cetera, et cetera, et cetera. They can go right out and we'll teach them the formulas on how to access those funds. And it's tremendously popular right now.
You know what? All of these programs enhance what you've been doing. And obviously there's success in what you've been doing. What do you see as the end game for COVID? And do you think that because of the fact that we've got this employment, more people are turning to lending sources like yourself in order to get the funds they need?
Oh, absolutely, yeah. In this semi-post-COVID period,
Right.
as you know, Jeff, we saw major reductions in the credit markets, the availability, accessibility of money. We were still getting the same number of people approved. However, the amounts for which they were being approved were significantly lower than pre-COVID. We're seeing that come back. We're seeing the interest-free periods being extended again. We've got players that withdrew for 3 or 4 months coming back into the marketplace and lending again. We think that for the real estate investor specifically, there's going to be a real boon in the marketplace. Either that's going to go positive, which they can take advantage of with these kinds of funds, access to these kinds of funds, or if it goes down, they'll be in a position to take advantage of opportunities that they wouldn't otherwise have had. I mean, I look back, we talk to folks about this regularly in our webinars and things like that, that if you knew 2008, 2009, 2010 was going to happen, what would you have prepared and what would you have done financially to be prepared to take advantage of all those opportunities?
Right.
But overall, we're seeing a lot of improvement in most markets.
I think that's absolutely true. I had a friend since passed away. He told me, and this was probably in 2006 and 7, he said, look, and he was advising me, and I was also advising our clients, get the money out of your house, put it away, and wait, because it's coming. The time is coming. And I don't know how many people took advantage of it because it was so widespread and so devastating. It was very difficult to really get a handle on it. But like you said, if you had that money and it was sitting there, we have 3.5 million people in forbearance. We have the largest late-term delinquency rate ever because of forbearance. What's going to happen if in January they do not extend the forbearance period? What's going to happen to all these people? Obviously, there's going to be some opportunities to try to, rid the banks of these kind of inventories. If in fact there's no extension, I don't have a crystal ball. I don't know if there will be, but absolutely, I think the business line of credit, being able to take money out and put it somewhere. Tell people how they qualify. What's the qualification?
I'm sorry. Did you ask for qualifications?
Yes, I did.
Okay. On the unsecured general purpose cash business lines of credit, it's really about data. It's not a credit score. It's the credit profile. And so what we do is we just do an underwrite on the data. It's blemishes on the credit report that have the biggest impact, and what type of blemish and how recent is that blemish. So, for example, late payment on a mortgage last month will have a bigger negative impact on the approval than late payment on a mortgage 5 years ago.
Right.
So it really comes down to their credit profile, not their credit score. So it doesn't matter whether they have a 760 or 680 or 660. They can get funded, and we crush it in that area. If there's an area that we have to fix, we get it fixed, and then we put them back in the program. On the unsecured cash, general purpose unsecured cash business loans, again, that's going to be more of a traditional underwrite. But with a little more latitude on that. So DTI now has gone down for this particular type of unsecured capital. So a client needs to be 43% or less on their DTI. We've got to have verified income. And again, it's about blemishes, not the particular score. So we're getting people approved at 670, and we're getting people approved at 770 on those. On the professional certification, the number one qualification there is they've got to be professionally certified.
Right.
We've got a couple of contractors in some states where certification is not required, but they're going in and getting it done now, and they know that once they have that done, 2 weeks later we can get them funded. There's a lot more latitude there. We can now take files with bankruptcies and some other things that weren't there before, that we couldn't do 6 months ago. On the real estate lines of credit, really straightforward. It comes down to is their mid-score 640 or higher? And then the other three criteria are liquidity, net worth, and experience. With experience being the next most important one. Someone who's done one transaction, one real estate deal in their life is going to be closer to $500,000. Someone like a gentleman out of Texas that we're working with right now, he's done 300 plus. He's going to end up with $6, $7, $8 million in his line of credit on that particular program. And again, these are money they've got. They can take advantage of opportunities either way, whether real estate rates or prices are going up or whether they're tanking. They've got the money. It's about being prepared. It's about having that money available now. Don't be there running around with empty pockets begging for money if the markets tighten up, if real estate pricing goes down. Be the group, be the individual or group or business that can go take advantage of those real estate deals.
Hey, Reed, could you shout out your phone number, a way people can get in touch with you, a place to go to fill out an app?
You bet. It's 801-830-6240. Let me repeat that. It's 801-830-6240. And one of the things that we did during this period of time, we become very digital. If someone calls me literally with our new phone app, I just tap it and I can send them the link. They click it,
right,
and they complete the digital formula. We're underwriting, literally, Jeff. We're underwriting.
Hey, Reed, we're up against the clock here. I'm going to have you back soon to continue to talk this conversation. But we got a commercial break we got to go to. I'm sorry.
Hey, you got to pay the bills.
Got to pay the bills. Exactly. Reed, thank you very much for once again enlightening and entertaining, as well as, informing people of what's out there in the marketplace. Thanks.
Well, thank you, Jeff. I really appreciate being on. You're one of the sharp guys out there in the marketplace.
Appreciate it. Thanks, bro. Appreciate that very much. That's Reed Blake from Intelligent Capital Solutions. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. Thanks very much for listening each and every week. You can also see us. We're on a couple of the radio stations. They do a video feed, KCAA, KMET. If you're listening in Albuquerque or Las Vegas, you cannot see us on your radio station, but go to YouTube, Jeff Barton, the Mortgage Voice, and you can see me there. We do shoot this as well as hear this on a number of platforms and over the airways. And yes, it is 2020, and that's what we're doing. By the way, it's COVID, so it's actually safe to do it this way. The message is out there. You can see me, hear me, and get up-to-date information on a daily if you go to YouTube, you go to LinkedIn, or you go to Facebook. This is, as I said, a weekly program airing each and every week, Saturday and Sunday, on a number of radio stations in a number of different places. Wanted to bring on a local person. And by the way, every market is local. So if you're talking about vast and grand areas in the real estate world, really you're only interested in your neighborhood or the neighborhood you want to buy in or the places you want to live or the places you want to sell to. The reason is because it's different everywhere. So if you're local in your area, let's try to hear what similarities you might get from my friend Phil Burson, joins us now from Compass Realty out in the San Fernando Valley in Los Angeles, California. Phil, how are you?
Doing just fine, Jeff. How are you today?
I'm okay. It's hot, as it always is at this time of the year. At least we're not burning down like some areas in California or like some areas politically. But we won't get into that on this show. What we try to do is, as you know, inform people as to what's happening. So tell us a little bit about what's going on in your market, in your business, that might be some informational plus for somebody who's listening.
Yeah. Yes, absolutely, Jeff. The real estate market has really been bananas, for lack of a better word. They're very, very active for the last few months with no signs of letting up. I believe it's because of low interest rates and lack of inventory out here that everyone's really shopping. Another big factor is with the stay-at-home and with COVID, people are finding out that their homes really don't satisfy all their needs. You know, do they have a swimming pool? Do they have a nice grassy backyard for their family? Do they have a home office? So it's right-sizing for the homes. With all that in mind, we're very, very busy with both buyers and sellers right now.
Oh, that's interesting. In terms of the low inventory, this is a national problem. It's certainly exacerbated by the fact that it's difficult to build. How are you seeing new homes, or are you seeing any new homes in your area?
We are not seeing that many new homes. There's a couple new developments with the big national builders like Toll, but really there's small little developments of new homes with 3 or 4, but the majority, over 90%, are resales, Jeff.
Okay, and how are your first-time home buyers or your new home buyers reacting to the fact that the prices are high, even though real estate mortgage rates have remained really historically low?
Yeah, I think that's what they realize. If they're going to be buying within the next 3 to 5 years, it's a great time because they're never going to see these low interest rates again. And even though the prices may be a little bit higher, your monthly payments is going to be the same. So, if someone is waiting to make a move and the price drops by 5 or 10%, but they're paying 2, 3, or 4 points higher, really, have they gotten ahead? No, they haven't. So again, right now, it's really that it's first-time home buyer, whomever, finding the right home for themselves and their families and be able to make a move on and securing that in a low interest rate for the next 30 years.
Do you see sellers more difficult to deal with in today's market than they were like 6 months ago?
What was that question again, Jeff?
Do you see sellers, when they're selling a property because of the demand on housing, more difficult to work with or less difficult to work with?
I think they're a little less difficult to work with because maybe they have more options. They may have 2 or 3 buyers all vying for the same property, so the sellers are able to pick and choose who they want to deal with and more on the seller's terms. So it's
right
for sellers right now.
Right. Now, I know you work, are you still working with family members in your business? That's still happening?
Yeah, absolutely. We are a father-daughter team. My daughter,
Excellent.
Ariana Burson, fully licensed and a marketing specialist. So she's doing a phenomenal job on our social media and modern marketing of our listings.
Excellent. How is that working, and exactly what areas or what sites or in the internet, where is she going to broadcast either your services or your listings or your whatever else you're talking about?
Sure. You can find us on all social under Barton Group. If you go to bartongroup.com or Google us, you will find us. We're with Compass. We're based in Calabasas, California, and taking care of all surrounding areas.
Okay, excellent. Now, because I'm an old guy, I really don't understand a lot of social media, even though the company that I work for is on all over the place. How is it that for buyers, are you seeing that the buyers are reaching you through your social media contacts, or are these mostly personal referrals, that kind of stuff? Because in the old days, it was a call to the office on floor time. Well, nobody does floor time anymore. So how are you obtaining your clients?
Most is referrals from past clients and sphere of influence. We are picking up a lot of followers and business through social media, whether it's on Instagram, Twitter, or just Facebook. And even right now, TikTok is another avenue for us to get good leads and help out some buyers.
Interesting. TikTok. Now, I happen to like TikTok, but as was told to me, it's mostly, like a goofy dancing site, right? Which is what I've seen when I go and watch. But how do you use that versus more traditional, like an Instagram?
We post videos, short videos of real, very nice properties that we're marketing, multi-million-dollar properties with beautiful lawns and swimming pools, and the public is looking for that right now. So they see the content, and then, they see the circle that we operate in, and they reach out to us, and, whether it is to list a home or find a beautiful property for them to purchase.
Oh, interesting, because I've wanted to get into the TikTok area, and I've just not known how to produce the type of content that younger audiences would look at and pay attention to. But you're saying, no, maybe not. Maybe just go traditional in what you're showing people, and those that are interested will give you a call.
Exactly, Jeff, yeah.
Okay, what's going to happen after the election when we get more of a calmer state of, I guess, neurosis in this country? Everyone's gone absolutely bat cuckoo about everything, and I don't know why that is. We've got a real problem in COVID, and we've got a real problem with unemployment, and we've got, some issues to deal with. How do you see that affecting housing?
I think there are a lot of people that are doing transactions and buying and selling right now, but there are a lot of people that are standing on the sidelines pending the election and the outcome of the election. It's the uncertainty that moves people to not take action. So I think after the elections, whoever gets in office, at least we will know about what to expect for the next 4 years, and then people can reevaluate and move forward on their purchases or sales.
It's funny. I happen to agree with what you just said. I think that people have been waiting on the sidelines because of COVID. Now they're waiting on the sidelines because of the election. I always say, well, as you're waiting, you're really waiting your life out. If you have a house, you want to do something, do it if you can afford it. There's no reason to wait. People get sidetracked. Even though housing is really busy right now, I think that's right, what you said about people getting distracted.
Yeah, I think so. Some people think of their home as an investment. History has proven throughout time the cycle in the real estate industry. You hold on to a property long enough, you will make money on it. But if you're out there looking now, what's important to the average consumer, if you're not an investor, is it the right place to raise your family? Is it the right atmosphere to grow and nurture your children? So
right.
That's what's most important these days.
I think so too. Hey, Phil, could you let people know how they can get in touch with you other than your social media? Do you have a phone number or someplace to get a hold of a great agent?
Sure, Jeff. Area code 818-425-7757. Again, 818-425-7757. This is Phil Barton. Thank you.
Hey, Phil, thanks very much for coming on. I really appreciate it. This has been Phil Barton from Compass Realty. Thanks, Phil.
Thank you, Jeff.
Okay, and I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in and listening, as well as seeing the program each and every day. We do a couple of 3 to 5 minute segments on a daily basis on LinkedIn or Facebook, Instagram, Twitter. There are a couple of Facebook groups that we belong to. There's a podcast group. And certainly what we try to do is get message to you, the consumer, people out there. Our biggest audience, of course, is through our radio shows, which we do 5 different stations, 3 different states, as well as YouTube, Jeff Barton, the Mortgage Voice. And we do appreciate if you go to any of these things, click on, you like it, you join the group. We can get the message to you each and every week, pretty much on time and at your leisure. So thanks again for tuning in and for listening to the show. Okay, let's talk a little right now about mortgage money versus lower quality borrower. We got into this a little bit with our previous guests. What does that really mean? There is tons of mortgage money available right now. And there has been since the Fed has been purchasing mortgage-backed securities to the total or the tune of $40 billion a month for years, not years, for months since COVID. And that's part of what they used to call quantitative easing during the last recession. Now they're calling it, what are they calling it? I don't know what they're calling it, but that's what it is. They're basically backstopping the mortgage-backed securities in the bond market. And thus, we have the lowest interest rates that we've really ever had. And as I said in the previous segment, I mean, let's just look at a couple of them. The 30-year fixed rate at 3% and the 15 at 2.44. Well, these are historic lows. And as a result of that, what we have is an overheated housing market. And we're seeing some areas go up, 4, 5, 6% a month, which is unsustainable, as everybody knows. What we'd like to see is 3 to 5% per year. And in some areas, of course, that is the way it is. But in the high populous area, the high demand areas, that's not what's happening. Now, because of COVID, we've had a flight from out of the metropolitan areas to areas in and around the metropolitan area. And as a result, those areas have also seen demand that they've not really seen. And they've seen people with money come to their area. So it's really made the local people who are trying to buy in that particular area not able to, because the prices have gone up so much. Now, luckily, we have low interest rates, which makes the dollar stretch. But as the prices go up, it really is kind of a wash. And we're not quite sure what is going to happen in the future. But let's talk about what I was just saying, this tightening credit standards, rising unemployment, as well as the mortgage money versus lower quality borrower. So in most cities, in most now outlining areas, as I just outlined, there's been this flight from the cities. What happens to somebody who was employed, can as a household, $60,000, $70,000 a year, two-person income? If they currently have now people making $100,000 a year flooding the market, being able to buy properties all cash, what happens to that borrower, that person that wants to buy, who is out there in the market wanting to buy, but they can't because now the market's too high? What happens to those people? Well, you're being told that the mortgage interest rates are horrific, so you should be able to get a mortgage and you should be able to buy a house, but you can't because, as I said, the prices keep going up. There is a disconnect here. Now, legislatively and in the political realm, we always have either initiatives or legislation or local ordinances which prohibit gouging or say, okay, we're going to freeze prices. This particular segment of our economy can't grow anymore because the poor person who's trying to rent, because they can't buy, is now protected. Well, of course, disincentivizing those people that want to get out there and buy something so that they can either sell it to somebody who wants to rent or rent it themselves. Housing equation gets out of balance and has been out of balance. Talked about this in an earlier segment. So the idea that, and we dealt with this during the 2008 mortgage recession. Let's call it the mortgage recession, right? Because everyone blamed the mortgage people for funneling money to people who could not afford it. It was always a talking point in those days that it was one party versus another party and they were at fault and they shoved this down our throats. Still the same problem. We've got tons of mortgage money, no inventory for low-income borrowers. So we call those borrowers low-quality borrowers, which is not necessarily true. If we had housing that, they could afford, like let's say you had a 1,200 square foot house that you could buy at $150,000. Well, now those low-quality borrowers look golden because obviously they can qualify at $60,000, $70,000 in a dual house income. You can qualify for that. To find that kind of home for those kind of dollars, you got to go. Well, if you live in Southern California, or you live in Albuquerque, New Mexico, or you live out there in Las Vegas, Nevada, hard pressed to find those kind of units available. New, not possible. Old, yeah, you can find them, but the demand is high. So you have to come in with an offer that is, no contingency, all cash. Oh boy, what do we do about it? How do we solve the problem? I think the problems can be solved, and it has to be solved in the private sector It has to be solved at the local level. I think there's enough incentive for builders, if they were assured of getting a faster track to building, which I think you could if you were able to look at a situation rather than one size fits all, be able to say, no, on certain situations in certain building, this can be done faster because we know quality, the way this is being done is better, or at least equal to what we're demanding of an individual stick-built house by an individual, either a homeowner or an individual investor looking to build and sell. What does that really mean? It means making it easier for lower income people to buy in areas that they necessarily can afford if the price is $150,000 versus $350,000. That's the issue. It's a supply and demand issue, but it's also, what are we going to do about the people who are homeless on the street? Go to any street in America that's got homes that are median priced of $500,000 or more, and you're going to see homeless there. Why? Because there's no place to put people if housing is so expensive. You have a divide that cannot be fixed unless you get lower income housing available for people. Let's just move on now. Okay, the tightening of the credit standards and the rising unemployment. Yeah, we touched upon that just 5 seconds ago. The credit standards for most lenders are becoming tighter. Why? Because unemployment on the horizon is seen as something that is inevitable, and the huge number of forbearances is not shrinking the way it was in June, July, and August. We're seeing 3.5 million forbearance properties still at 3.5 million. It means since March, these people haven't paid a mortgage, and there's an even bigger number that hasn't paid rent. This is nationally, of course. This isn't in your town. This is spread out across America, but it's a big number. So when we see in the future, okay, we might have more layoffs at Disney, at any of the theme parks, at certainly the airlines. A couple of them are looking at bankruptcy because they just can't afford it without the PPP loans that they've been getting, which ended. So what happens now if we're looking at rising unemployment rates and tightening credit standards? It means that fewer people can get loans, right? Which means that the divide for those that can and can't becomes wider, which means that the renters are going to put pressure on landlords to come up with more housing or raise the rent. I mean, it's a supply and demand situation, exacerbated, of course, because now we're getting legislation, and of course, I've said it 100 times during this show, but it makes me so cranky because what are we doing about it? We're slapping Band-Aids on problems that need long-term solutions is what we're doing. The corporate, private sector, and legislative solutions are all coming at it from different wants. Corporations, the KB Homes, and a bunch of these Pulte and Aspen home loans, they all want to make dollars. The homeless guy on the street just wants a place to sleep. The person who is at the legislative level locally, hey, they're just trying to be reelected. There are solutions, just got to come together. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening. Thanks for tuning in. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.